Hello, welcome to Accounting Hub. I'm Professor George Carpin, PhD in accounting, and our topic today is bad habits. Bad habits, we have two methods. So, bad habits, we sell it on credit, however, we will not receive it. So, what is the right write-off method? Wait until a particular account is deemed uncollectible and write it off at that time. Not allowed by GAAP, so not allowed in the US, and not allowed by IFRS, so not allowed anywhere. So why do we have it? Because it is required for tax in the US and most of the countries. How does it work? Overstay, and we have some problems here because it overstates the balance in accounts receivable in the periods prior to the write-off, distorts net income by postponing recognition of any bad debt until the period in which the customer actually fails to pay. So when it happens, debit, bad debt, expense, credit, accounts receivable. It is just like a cash basis accounting. We just wait until the transaction happens and then we record it. However, we have a second method called it allowance method. This is the method required by US GAAP and IFRS. Companies use a contra asset account, the allowance for uncollectible accounts, to reduce the carrying value of accounts receivable to the amount of cash they expect to collect. Both the carrying value and the amount of allowance typically are shown on the face of the balance sheet. So here, how we present it, accounts receivable trade less allowance for doubtful accounts. So here is the net value of the accounts receivable. Okay? So what do we have here? Bad debt expense is not recognized when specific accounts are written off. It is recognized earlier when accounts are estimated to be uncollectible and the allowance is created. Later, when a specific account receivable is deemed actually uncollectible, both the allowance and the accounts receivable are reduced to write off the receivable. So we don't have bad debit expense here. Whoa. So let's go to our Excel file. So our Excel file, if you are a regular here, you already know that. If you are a new one, I want to let you know that all of our Excel files, they are free to download and the link is in our video description. Okay, so, okay. Skype Incorporation started operations in 2020, so no previous balance. We have sales 2.5 million and collections of 1,850,000, leaving a balance of $650,000. So in accounts receivable as of December 31st. So this is our first. So let's delete it here and let's do it together. So here we have sales. Let's consider that the sales are on credit. So debit accounts receivable and credit sales revenue. So the T account of our accounts receivable debit. We will not uh, work with the cost of goods sold journal entry because it doesn't matter for us. Collections 1,850,000 debit cash and credit accounts receivable because we are decreasing the balance. And here, December 31st, ending balance of 650. Scraping analysis indicates it expects to collect only 575. So we must establish an allowance for uncollectible account of $75,000. How do we find it? 650, the ending balance, less 575. So let's do it. Let's recognize here. So here on December 2020, so on 2020 here, we will have our bad habit expenses. Expense. $75,000 debit because expense we debit it and we credit the allowance. So here we are crediting our contra account. So in our balance sheet here, in balance sheet, the accounts receivable will be, oops, receivable will be 650 less 75. It will be 575. That is how much we expect to collect. And let's go on April 19th. That is my birthday. Oops, not Hawthorne. Come on, it's our company, Scarping Corporation. So sorry, guys. Concludes that it will not collect a 38,000 dollars receivable from a customer that recently has gone bankrupt. So okay, now it is the written off, and we debit the allowance and we credit accounts receivable. So no expenses here because we are reducing uh, our accounts receivable and reduce our allowance. And occasionally, a receivable that has been written off is later reinstated. When this happens, to entry the written off the account is reversed. Assume Scarpin learns on May 30th that the financial situation of its customer has improved and it will collect $14,000. So we only reverse this journal entry here. So debit accounts receivable and credit allowance. Okay, so this is the how do we uh, record the bad debits. Okay, guys, and what do we have here? We have two methods to do that: the balance sheet approach and the uh, current expected credit loss that is started on 2020. That is a very subjective and qualitative method here. But the balance sheet approach, the bad habit expense uh, on the appropriate carrying value of accounts receivable, company estimates what the ending balance of the allowance for uncollectible accounts should be, and then records the amount of bad debt expense necessary to adjust the allowance. So let's consider at the end of 2020, Scarping Corporation has a gross accounts receivable of 900,000, but believes it will collect only 820. So we need an ending balance of 80. So if our beginning balance is 51, the bad debit expense will be 29. That is what we have done in our Excel file. And we have a second one. Bad debit expense direct as a percentage of each period's net credit sales. So if Scarping had sales of 2.5 million and estimated that 2% of those sales would prove uncollectible or $50,000, this is our bad debit expense. So balance sheet approach, we calculate the ending balance. Income statement approach, we calculate the bad debit expense. In the US, both are allowed. In a lot of countries, we have only the income statement approach. Okay, guys, so that's it. Thank you so much. Subscribe our channel. You will be the first one to know when a new video arrives. Like our Facebook page, Accounting Hub by Dr. Scarping. And like this video, please. If you have questions or comments, leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.